Welcome to the Deep Dive, the show that really gets into the nuts and bolts of the industries shaping our world.
That's us.
Today, we're focusing on something absolutely critical but often invisible:
Right,
logistics.
the backbone of, well, pretty much everything now, especially e-commerce.
Exactly. It affects what you buy, how fast it gets to you, everything.
And so for this deep dive, we're going to unpack the Q1 FY26 results from delivery.
A major player in India's logistics scene.
Yep. Our mission here is to go beyond just the headlines from their reports, their earnings call.
We've got the press release, board disclosures, shareholder letter, investor decks, the full call transcript, the works.
And really pull out what matters, what these numbers mean for delivery, for the logistics industry, and maybe even for you.
Okay, let's get into it. Deliveries Q1 FY26. Was it really a strong start to their financial year?
Well, the short answer, yeah, it looks like it. The big picture shows some pretty significant improvements.
Okay, so let's talk top line first. Revenue from services. What are we seeing there?
Okay, so revenue from services hit ours, 2,294 crore. That's up about 6% year on year.
And 5% from the previous quarter too, right? So steady growth.
Steady growth, yeah. Total income around ours, 2,424 crore, same kind of growth pattern. But the really interesting stuff happens when you look at profitability.
Right, that's what caught my eye. The EBITDA.
Exactly. Earnings before interest, taxes, depreciation, and amortization, it jumped to ours 149 crore.
Which is, what, a 53% increase year on year from ours 97 crore?
Precisely. And maybe even more telling is the margin expansion. Their EBITDA margin went from 4.5% last year to 6.5% this quarter.
That's a big jump. 200 basis points.
200 basis points year on year and about 110 quarter on quarter shows real operational leverage kicking in.
And the bottom line, profit after tax, pity D.
Even better story there, arguably. Ours, 91 crore. That's a 67% jump compared to Q1 last year.
67%.
Yeah. And the PT margin climbed from 2.4% to 3.8%.
And you really need to see the trend here, don't you? Just 2 years ago, Q1 FY24, they were at negative 4.4% PT margin.
Right. Then positive 2.4% last year, and now pushing 4%. It's a clear path from, let's say, growth at all costs.
To something that looks much more sustainable.
Exactly.
Right.
And here's a little nugget from management. They actually said their core profitability is even higher.
Oh, how so?
Well, the reported numbers include about ours 14 crore of investments they're making in brand new services.
Ah, okay. So the established parts of the business are performing even better than these headline numbers suggest.
That seems to be the message, yeah. Bodes well.
Okay, so to really get this, we need to break down the different parts of their business. Let's start with the big one, Express Parcel. That's the volume driver, right?
Absolutely. The juggernaut. They handled 208 million shipments in Q1.
208 million, and the growth.
Pretty solid. 14% year on year, and actually a really strong 17% jump compared to the previous quarter.
Wow, 17% QOQ. That's significant momentum.
It is. And they mentioned that momentum carried on into Q2 into July as well. Revenue for Express Parcel with up 10% YOY, reaching ours 1,403 crore.
Now, what about the yield? I saw some discussion about yields potentially dropping slightly. Was it a concern?
Right. Good question. Management addressed that directly. They said, look, it wasn't a pricing issue.
Oh.
It was because the average weight per parcel dropped by double digits. Basically, the mix of what they were shipping changed.
Ah, so lighter packages on average.
Exactly. And they expect yields to naturally increase again during the peak season, Q2 and Q3, when you typically see more heavier items being shipped.
Got it. And competition, are they worried about price wars?
They seem less worried now. Management feels the risk of sort of irrational pricing is lower.
Why is that?
Partly the Ecom Express acquisition, which we'll get to,
Right.
but also because other 3PLs are facing financial pressure, they basically need to cut their cash burn.
So less room for aggressive discounting across the board, makes sense.
Okay.
And the profitability of this segment, the service EBITDA margin.
Still strong. It's at 16.3%, and it's been expanding. Came up from a low of 15.1% back in Q2 of FY25.
And they have a target for that.
Yep, they're aiming for 18% by the end of this financial year, FY26.
Driven by.
More volume, better use of their network, and getting more productivity out of their staff. Standard efficiency drivers.
Okay, so Express Parcel, big volume, solid growth, improving margins. Now let's switch gears to Part Truckload, PTL. This one seems like a different kind of story.
Oh, definitely. If Express Parcel is the volume engine, PTL is like the margin turnaround story. It's quite dramatic.
Okay, lay it out for us. Tonnage.
Tonnage grew 15% year on year to 458,000 metric tons. Now, it was kind of flat compared to the previous quarter,
Which might sound weak.
but Q1 is usually the seasonally weakest quarter for PTL anyway. So holding steady is actually pretty decent.
And revenue.
Power is 508 crore, up a healthy 17% year on year.
Okay, but here's the kicker, right? The service EBITDA margin for PTL.
This is where it gets really impressive. It expanded to 10.7%.
10.7% from what?
Well, just 3.2% in Q1 of FY25. And if you go back another year, Q1 FY23, it was negative 43%.
Wow. Okay, that is a turnaround. What drove that massive improvement?
It's a combination of things. They managed to improve yields, getting more revenue per kilo.
How much?
Went from about Rs 10.12 per kg last year to Rs 11.1 per kg this quarter.
Okay.
Plus, more customers are taking up their value-added services. And then there's the operating leverage, better use of their trucks and hubs, and again, staff productivity gains.
So a real focus on operational efficiency paying off here.
Absolutely. It looks like a masterclass in turning that segment profitable.
And the outlook for PTL.
They expect growth rates over 20% annually. They see a big shift happening in the market towards what they call express PTL, and just more business moving to organized players like them.
Right. And there was an interesting point about quick commerce, wasn't there? How does that fit with PTL? Seems counterintuitive.
Yeah, you'd think quick commerce is all small local stuff, but it's actually creating a material opportunity for PTL.
Oh.
Think about supplying the quick commerce mother warehouses and the dark stores themselves. These often involve complex B2B shipments.
Ah, the back-end logistics for quick commerce.
Exactly. Stuff that needs appointment-based delivery slots, electronic proof of delivery, services where Delhivery's PTL network can add real value.
Interesting angle. Okay, let's move to supply chain services, SCS. The numbers here looked a bit different. Revenue decline.
Yes, revenue was Rs 205 crore, which was down both year-on-year and quarter-on-quarter.
So what's the story there? Is that a problem area?
Not according to management. They say this was a deliberate strategic move.
Strategic decline, how does that work?
They exited some unprofitable projects. Specifically mentioned providing mother warehousing for quick commerce players. See if they decided the margins weren't good enough there.
Okay, shedding low-profit business.
Right. And there was also some seasonality impacting a major electronics client. So it wasn't an across-the-board weakness.
And did profitability improve despite the lower revenue?
It did, actually.
Yeah.
The service EBITDA margin for SES expanded to 7.2%, better operational management within the contracts they kept, and renegotiating terms on some of them. Again, focusing on quality of earnings, not just revenue size.
Makes sense. And their ambition for SCS?
Pretty high. They're targeting Rs 1,800 to 2,000 crore in revenue in the next 3 years.
Okay.
But with a service EBITDA margin over 12% and a return on capital employed over 20%. So profitable growth.
And they're seeing traction.
They mentioned a deeper client pipeline and good uptake for their Prime service, which is aimed at direct-to-consumer brands and smaller e-commerce businesses.
Right, building a solid foundation there. Okay, quickly, what about the other smaller segments? Full, truckload, FTL, and cross-border?
Sure. FTL revenue was basically flat, around Rs 148 crore. The interesting thing there is their Orion platform.
What's that?
It's like a digital freight matching platform. It's handling significant transaction volumes now, and their plan is to build more services on top of it.
Like what?
Things like offering fuel discounts to truckers using the platform, or maybe working capital financing.
Ah, so turning it from just matching loads into a broader ecosystem for truckers.
Exactly. Make it stickier, create more revenue streams.
Smart. And cross-border?
Smaller segment, Rs 24 crore revenue.
Yeah.
Key thing there is they're launching a new economy parcel product in Q3.
Aimed at.
Expanding their reach, probably targeting more e-commerce sellers looking for cost-effective international shipping options.
Okay. So underpinning all these segments is their operational network and efficiency, right? Let's talk about that.
Yeah, absolutely crucial. Their PIN code coverage is huge, 18,857, and plan to hit around 19,200 once Ecom Express is fully integrated.
And they added a lot of customers.
Nearly 8,000 new active customers in the quarter, bringing the total to over 43,000.
Wow. And the physical infrastructure?
Massive. Over 20 million square feet of logistics space, 119 gateways, including the integrated e-com ones, 45 automated sort centers.
Automated sorting is key for efficiency at that scale.
Definitely. And they have over 3,600 of their own express delivery centers, plus partner centers, taking the total to 4,500. They expect that to reach nearly 4,800 by year end.
What really struck me was the point about utilization, how they're getting more out of these assets.
Yet that was a great example of operating leverage. They said for every 1% increase in the number of delivery centers,
Mm-hmm.
their volumes went up by 14%.
14%. So each center is handling way more volume.
Exactly. It implies a 14% increase in utilization for those centers. Same kind of story for their sortation centers, too. It shows their network can absorb growth really efficiently now.
Which feeds directly into the better profitability we saw earlier.
Precisely.
And they're managing costs elsewhere, too, corporate
Hold on.
overheads.
Yeah, that's come down significantly as a percentage of revenue. It was 11.4% back in FY23. Now it's down to 9.1% in Q1 FY26.
And they think it can go lower.
They're aiming for 6–7% in a steady state, even accounting for wage inflation.
And the main operational costs: freight, handling, servicing.
Those are holding steady around 71.4% of revenue. Seems well managed. It's about building a leaner machine overall.
Okay, let's talk about the big strategic move: acquiring Ecom Express. That deal closed recently, right?
Yes. CCI approval in June, acquisition completed July 18th. So the financials get consolidated from that date onwards.
Purchase price was around Rs 1,369 crore.
That's right.
Now, integrations like this can be messy. How's it actually going?
Well, according to them, pretty smoothly, maybe even better than planned. They said the volume and client integration is mostly done.
So Ecom's packages are already flowing through Delivery's network.
Yes, and that impact will show up properly in the Q2 numbers.
But here's the really interesting bit you mentioned earlier, the volume retention.
Yeah, this was quite surprising. They initially planned to retain maybe 30% of Ecom's volumes, focusing on the profitable ones,
Right.
but they're actually retaining much more closer to 55–65%.
Why such a big difference?
They're attributing it to a flight to quality. Basically, as things get tougher for smaller, less stable logistics players, clients are moving towards more reliable, established networks like deliveries.
So Ecom customers are choosing to stick with the integrated delivery system. That's a strong signal.
It really is. And network rationalization is on track. They're keeping 7 key Ecom facilities and integrating them.
What about the costs of integration? Layoffs, closing leases, etc.
Estimated around Rs 300 crore. They said it will be concentrated over about 6 months from the acquisition date, mostly people costs and lease wind-downs. Importantly, they plan to report these costs separately.
So it won't muddle the underlying performance numbers and the broader market impact of this consolidation.
Management definitely noted less intense price competition in the 3PL space.
Directly linking it to financial pressures on competitors.
Yes. And crucially, Delhivery is applying its own pricing discipline to the Ecom contracts they've retained. No loss-leading deals just to keep volume.
Sounds like a move towards a more rational market, perhaps.
That seems to be the hope. And Delhivery is certainly positioning itself as a key beneficiary of that trend.
Okay, beyond the big acquisition, they're also investing in new services, right? Planting seeds for the future.
Exactly. 2 main ones highlighted were Rapid and Delivery Direct.
Tell me about Rapid.
So Rapid is about ultra-fast fulfillment. Think sub 1 to 3 hours. They have 20 operational dark stores for this already.
Generating revenue.
Yeah, a monthly run rate of 1.2 crore currently. The plan is to double the number of stores to 40 by the end of FY26.
And where's the bigger potential here?
They see significant opportunity in rapid B2B fulfillment.
Ah, like getting critical parts to businesses super fast.
Exactly. Think automotive spares, electronics components, things where speed is paramount for a business customer.
Okay. And Delivery Direct.
That's their C2C play. Consumer to consumer, on-demand, intracity pickup and delivery. Like a competitor to local courier apps.
Where's that launched?
Ahmedabad, Delhi NCR, and Bangalore so far.
And how's it doing?
Interestingly, they mentioned Ahmedabad actually hit contribution margin break-even in just about 4 months.
It's quick for a new consumer service.
It is. Suggests there's real demand. And they see this as a huge potential market, estimating it at over $10 billion.
Wow. But these are still small bets for now.
Very much so. Remember that Rs 14 crore investment figure in Q1? That covers these new initiatives. It's definitely a long-term play.
Okay, let's pull back to the bigger picture. Financial health, capital allocation. How are they managing their money?
Well, one key trend is sharply lower capital expenditure, or CapEx intensity.
Meaning less spending on new buildings, trucks, sorters as a percentage of revenue?
Exactly. It peaked at 6.8% of revenue in FY22, down to 5.2% in FY25, and they expect it to fall to around 4% by FY28.
And the Ecom deal helps with that?
Yes, because they acquired existing infrastructure, reducing the need to build as much themselves. It's a capital-efficient way to grow capacity.
What about working capital, managing cash flow?
Big improvements there too. Net working capital days, basically how long their cash is tied up in operations, has fallen dramatically.
From what to what?
From over 40 days back
Yeah.
in FY21 to around 20 days in FY25. And they expect another 8–10% improvement.
So much tighter cash management. And where are they putting their cash?
Focus is on, well, growth opportunities, expanding the network, the fleet where needed, funding strategic acquisitions like e-com, and also evaluating owning more assets versus leasing, making smart choices about capital deployment.
Right. And this all leads towards their long-term goals for profitability and returns.
Yep. They have an aspirational target for return on capital employed, ROCE,
Which is
above 24% for the core express parcel and PTL businesses.
24%. How did they get there?
They're aiming for roughly 3x asset turns, getting 3 rupees of revenue for every rupee of assets, and an adjusted EBITDA margin of around 11% after factoring in corporate overheads.
Ambitious targets. So let's bring it back. What does all this, the efficiency gains, the acquisition, the new services, the financial discipline, what does it mean for you, the listener, the end consumer?
Well, fundamentally, it means Delhivery is doubling down on becoming a highly efficient, profitable, and sustainable logistics machine. They're betting that operational excellence, smart acquisitions, and targeted new services are the way forward.
And for the person getting a package.
For you, it can mean more reliable deliveries, potentially faster options through things like Rapid, and just a smoother overall experience as the underlying network gets stronger and more streamlined. Every time you click buy, this complex system is working in the background.
The invisible backbone.
Exactly. And Delhivery is trying to make that backbone stronger, faster, and more efficient. It underpins so much of the digital economy.
So as we wrap up, maybe a final thought. As delivery keeps growing and refining its operations, maybe we should think about how the efficiency of companies like this isn't just about packages.
Right. It could be a real indicator of a country's overall economic health, especially its digital commerce maturity.
And the question becomes, how much more efficient can this invisible backbone actually get? Could it unlock completely new ways we shop or receive goods in the future?
It's a fascinating space to watch. That constant drive for efficiency and scale could have ripple effects we haven't even fully imagined yet.
Definitely something to keep an eye on. Thank you for joining us on this deep dive into Delhivery's Q1 FY26.
Always a pleasure.
Stay curious and keep exploring the dynamic world of logistics.